Hey everyone, hope you're well and enjoying the week. Thanks for joining me. My name is Ben and I wanted to go over today a few articles around some of the companies that I hold that might interest you. And as always, I will be finishing up with a portfolio update around what's happened over the last week. So make sure to grab a drink, take a seat, and we'll go over some of the recent news and you can join me on my investing journey. Now, the first thing that I wanted to talk about is actually a story around Apple, who are rumoured to be releasing a new version of their smartwatch, this time a more rugged design. The new watch would most likely include all of the same features as the current lineup of smartwatches, but would be built in a more rugged and resistant manner, therefore making it more suitable for people that enjoy extreme sports and outdoor activities. It's likely that if Apple choose to go ahead with this product, that we're not going to see anything till the end of this year, potentially next year. And this information has come from people who are allegedly close to the company, but would like to remain nameless. We have seen features that would be useful in this style of watch and useful in activities such as hiking across the current range, such as the always-on altimeter, which is a way of recording how much someone's climbed during a hike. I believe these features are already on some of the watches in the system, such as the Apple Watch Series 6 and the SE, but it's not a hard stretch to see them just adjusting the ruggedness of a case to make it more suitable for outdoor activities. And I can also see it being appealing to hikers and outdoorsmen in general that do have a fondness for the Apple ecosystem. TrendSpotter currently have the best watch for hiking and similar outdoors activities listed under the Sunto Core, which is a composite cased watch that includes a crystal glass front and an aluminium bezel. It's also around 1 centimeter larger than all of the Apple smartwatches. So I'm unsure if Apple would be looking to keep their normal sleek design or would potentially be making the watch slightly more chunkier to match its competitors. I imagine they're going to keep their same design just with a more durable case. Overall, even though I'm not an Apple user, I'm not in the Apple ecosystem at all, I do feel that it is a good move for the company to make, as it would potentially look to take some of the market share away from the Sunto watches. Sunto are a company that is owned by Amir Sports, who in turn are owned by a Chinese group called Anta Sports. I am looking forward to see if Apple do this and what the outcome of this would be. But in other news, we have got a story around BMW and PG&E, who are now entering the third phase of the Charge Forward program. The Charge Forward program is aiming to test and also learn how electric vehicles could support the integration of renewable energies into the electric grid. There is a pilot available to PG&E customers who drive a BMW electric or a BMW plug-in hybrid. There is around 3,000 drivers that can sign up for voluntarily allowing their vehicle to be charged in a smart charge manner, which will charge when electricity demand is low and the renewable energy availability is high. As explained by Adam Langton, who is BMW's energy service manager, he said, let's assume that someone plugs in at home on a Saturday morning at 9 AM and sets their departure time for 4 PM that day. The Charge Forward software system communicates with the vehicle and determines that the battery is more than half full and would need around 2 hours to charge and fill the battery. The system evaluates the person's home electricity rate, renewable energy availability, and congestion on the grid in their neighbourhood. On this day, there is no congestion on the grid and the solar energy will be very high in the afternoon. The Charge Forward system directs the vehicle to start charging at 1 PM and complete its charge by 3 PM. This allows the driver to get a full battery prior to their departure time. BMW and PG&E will also be collaborating in a lab setting to explore a vehicle-to-grid technology that may enable electric vehicles to discharge electricity back to the power grid. Such bidirectional functionality could allow electric vehicles to be used as essentially a backup generator in the case of emergencies or a distribution failure from the power plants. To help balance things out generally throughout the day if there was an imbalance, these cars could be essentially plugged in and donate their power back to the grid. With the third phase of the Charge Forward program beginning in mid-April and running through to March 23, it would be interesting to see what happens here. I have also got a slight concern around the fact of the smart charging. I'm not sure how it would work if you plugged in, say, at 9 o'clock in the morning, said you were going out at 4, but then had an emergency and had to go out at midday. The last thing I'd want to do is go and find out that my car has given all of its electricity to the grid because it doesn't think I'm using it, and that I don't currently have a charged car because it isn't expecting me to go out. So I would like a little bit of clarity from BMW around what's happening there, but it is still, I believe, a good overall move the company itself, as it would give them essentially an option to reduce costs for the customers that are using these charging abilities. Overall, I feel generally this is a bit of good news for the environment, and also nice to see companies like BMW taking the initiative and taking these steps. If all goes well, this could reduce the risk of potential electric infrastructure failure in the event that in the future the public are using a large amount of electric vehicles. But finally, I also wanted to touch on a last story. This time it is around Pepsi, who seem to have plans to have around 15 electric semi-trucks on the road by the next year. Now, we all know Pepsi, the producer of that cola drink, but they also produce multiple other brands of drinks and also a lot of snack foods. We have not been formally told by Pepsi who the supplier of these new electric vehicles will be. However, in light of a deal between Tesla and Pepsi in December 2017, it's a good bet that these vehicles will be coming from Tesla. The Tesla semi-trucks will be powered by 4 independent motors and feature a version of the Tesla autopilot system, which is giving Tesla the reason to say that it will be the most comfortable semi-truck ever. Overall, again, I think it is a bit of a good move for the company, and also it's good for the environment as well. It seems that Pepsi have been running a pilot program in one of their California facilities, which is one of their largest facilities. In a recent update, they have said that they have managed to reduce their greenhouse gas emissions on that location's fleet by about 53% across the last year. So the introduction of these vehicles may help to increase that reduction, and it would be interesting to see if Elon Musk jumps on Twitter to shout about it. But until that happens, let's jump over to my portfolio and see what's happened over the last week. Looking over to the portfolio and the changes from the last week, we can see that my portfolio value has increased from 2,468 up to 2,589, which is an increase in return from 9.82%, which is around £220, up to 11.75%, which is around £272. So in total, my portfolio change was around £120, and the return increase was around £50. If we actually compare this to the S&P 500 Vanguard ETF, which is, I believe, ticker VUSA, which over the last week has seen an increase as well, this one being around 1%, we can see that my portfolio seems to have given higher returns, with my portfolio returning an additional 1.93%, so near on double of the Vanguard ETF. I'm relatively happy with this, as over the last couple of weeks in the drops of return, my portfolio has generally performed slightly better than the ETF by losing less than the ETF itself has lost. And equally this week in the regards of gains, my portfolio has gained more than the ETF. So I feel that I'm in a position where I could say my portfolio is outperforming the S&P 500 ETF by Vanguard, but I feel that I need a little bit more information and I should carry on doing this in future. If you think of a better ETF that I can compare this against, please let me know down in the comments below and I can look to include that instead or include it with this current one. And I thought we should probably now move over to what I've bought and sold over the last week. And in regards to selling, I've done no selling, but I did do some buying. And this started the week on the 23rd by buying 1 share of Store Capital for a total of £23.81. On the following day, I picked up 2 shares of GSK for £25.82. I also picked up half a share of AT&T for £10.99. And finally, 0.1 of a share of Apple for £8.81 as they had their recent drop. My reasoning behind these purchases is that I believe that the companies are either undervalued potentially, or are companies that I already have in my portfolio, but they're trading below my current investment rate. So therefore, by buying them, I am slightly reducing my average buy-in value. These purchases bring me in total Store Capital position to 5 shares, my GSK position to 7 shares, my Apple position to 0.6 of a share, and my AT&T position to a full share. I would be hoping for a rough increase in yearly dividends of around £4.10p from these purchases, and that's not including any of the potential withholding tax for non-UK stocks. Which, as planned, takes me over nicely to the dividends and what has happened over the last week in regards to that. I pulled in a total of 40p. This is formed by a 20p payment on the 22nd from Pembina Pipeline for holding 2 shares, and then another 20p payment this time from Dominion Energy on the 24th, and I currently hold half a share for them. I am hesitant to give a heads up on the purchases that I'm thinking of buying over the next week. The last time I did that, it went a bit astray as a different company I didn't mention dropped dramatically in price and I took advantage of the situation. However, if that doesn't happen this time, I would be looking to pick up some more Store Capital, AT&T, Abbvie, and potentially AXA, though I do want to recheck all of the company's financials just before I start putting more money into the company. I do believe that most of these companies are in a good value position. Even AT&T, who did show a loss last year, I believe that was a one-off scheduled loss rather than just general poor business. So it isn't as concerning as I initially thought. And if there is anything you want me to expand on, obviously let me know. If there's any bit of information you think that I've not touched on as heavy as I should, please let me know, but I don't want to make these videos too long. And that is my update. So please remember to like and share if you haven't already. And until next time, remember to invest, save, and subscribe.